Thanks, Josh, and thanks to everyone for joining us here this afternoon. So as Josh mentioned, we're going to just dive into a little bit of market conversation, a little bit of COVID conversation, because that is certainly the topic du jour and the topic that is really driving markets and the economy and the whole world right now. We are certainly in a COVID world right now, and it's driving a lot of the thinking. So we want to just talk about how we're thinking about it and interpreting all the data that we're seeing. Before we get started, we do want to, remind you that investments are going to be the topic of this presentation and a big part of what we do at Archetype. But we at Archetype really pride ourselves on talking about and working with the what we call the four quadrants of everything that touches your financial life, which is yes, investments, but also your family, your legacy, and your long-term financial plan. So again, we're going to touch on investments today, but if you'd like to talk to us about any of these other four quadrants, we'd love to continue that conversation with you. So the topic of our conversation today is the three dials. This is what we call our three primary market indicators, the three things that we use to try to distill everything that we see, everything that we read and hear through one of these three dials. We're going to talk about what they are, how they work individually, how we interpret them in concert with one another. So we're going to dive in here this morning, obviously, or this afternoon, I guess now. We're going to, I think the big question that we're going to try to answer, or at least try to talk about, is what is driving financial markets both now and over the course of history and into the future. I think financial markets are, fascinating, but one of the most complicated aspects of life and one of the most important aspects of life, the financial world and in the world beyond just money and investments is all interconnected and all driven by just so many, almost an uncountable number of factors. So the question is, how do we make sense of everything that is going on in the world, both financially and maybe even peripherally or not at all related to the financial markets? And so what we try to do is just take opinion and emotion out of the conversation as much as we possibly can and try to filter all the news and the noise through a data-driven lens. So there are two kind of big risks when it comes to investment planning. One is what we call analysis paralysis. It's basically looking at a vast and complicated world and trying to basically make sense of everything and ended up just being paralyzed and unable to put a coherent thought together or a coherent plan together because there's just too much data flowing at us. We end up getting paralyzed. Now, the other thing that we want to avoid, the other side of that coin, so to speak, is really just getting buffeted and blown around by every single piece of financial data or news or headlines, especially news headlines that we see. So we want to have some sort of firm foundation, some sort of basis and fact and data, and not being blown about by whether the GDP print came in slightly below expectations, which we're going to get to. It happened this morning. Or whether inflation was 1 percentage point higher than expected. So having some sort of firm foundation, not being blown about by every piece of data, but being able to interpret, what comes at us. So again, what we use is called the three dials, our three primary market indicators. The three dials that we look at and the three things that we think ultimately drive the largest share of movement in the market is one, momentum and sentiment, two, economic fundamentals, and three, valuation. So we're just going to dive into what we mean when we say each of these three dials, and we're going to talk about, again, how they work together. So dial number one for us is market momentum and sentiment. The simplest way and the simplest axiom that we have to remember that one is just the trend is your friend. So in a bearish market or in a long-term downtrending market, we want to take as much risk off the table as we can, of course, in the context of the individual's or our client's financial plan and goals. By the way, none of this is the same for any one investor, but we do use the same kind of framework when we're thinking about and talking about our asset allocation. So again, in a bearish market or in a downward trending market, we want to be risk off, like we saw in 2008 and 2009, just this waterfall decline market. But when we think we're in this longer, secular uptrend is when we want to be maybe dialing up the risk marginally and pushing the upper bounds of our risk tolerance, so to speak, to capture some of that upside of the long-term market. So, generally speaking, the long-term trend of markets, if over history, is in an upward direction. But as we know, markets can fall fast and hard, and when that does happen, and when we do foresee events like that happening we want to try to get out of the way of that as much as possible. So, where is momentum and sentiment currently? It's a difficult question to answer, certainly. Each of our dials, by the way, is going to have three possible readings: a negative, a neutral, or a positive reading. So what we do is with every data point, we try to determine if we're in a negative reading, a positive reading, or somewhere in the middle. So when we're looking at our momentum and sentiment dial, we consider that to be in a neutral position for time reading. We're kind of in this holding pattern of COVID. Again, we saw kind of at the beginning of March a very sharp and perhaps overdue sell-off in combination with valuation, which we'll touch on a little bit later. But we saw this swift, 30+% sell-off across most markets. Some even more than that. And then we've had a fairly surprising and quick, recovery here in the last few weeks. So the month of April has really been strong for U.S. equities in particular. So what do we make of that from a momentum and sentiment basis? Another thing that we look at, especially on the sentiment side, is what we call the VIX index. It's the volatility index. Some people call it the fear index. And where is that right now? It's simply put, it's really the cost of insurance on a portfolio. So when that index tends to go up, that means there's more fear in the market. That tends to be a somewhat bearish indicator. That kind of approached record highs in the last month, and that's come down significantly. So we see that as a good sign that momentum is firming up. Now we're still fairly elevated in that fear index. We still have yet to recover kind of some of the stable long-term moving averages in equity markets, but we've certainly made a lot of progress in the last few weeks. So we are encouraged that momentum and sentiment has firmed up here in the last few weeks. We're not, we don't think we're barreling towards new highs. We don't think we're rocketing towards 3,400 on the S&P anytime soon. Again, certainly probably not within the next 6 to 9 months. But the fact that we're back up over 2,900 on the S&P this morning, we got some good news on a potential antiviral treatment for COVID from Gilead, who's been one of the companies on the front line of developing treatment. We think the next big wave is obviously going to depend on the vaccine, and we're seeing some positive strides there as well. Now that's going to take a lot longer, obviously, just on the nature of vaccine development. But the researchers out of England are making pretty good progress there as well. So encouraging signs on that front, but obviously there's a lot of damage that needs to be recouped in the markets. Now we have had some questions about how can the markets recover so quickly when the data is only getting worse. We think it's important to note, and we can distribute some more research on this, but markets are always a forward-looking mechanism. So you're never paying when you're buying a stock. You're never paying for past performance. You're not paying for past gains or data. You're always looking towards the future. And what markets have done is in the beginning of March, they rapidly discounted a steep economic decline, and that's when you saw markets really fall off about 30% in a very historically quick manner. And now we've seen this recovery on the assumption that things are going to get better. Now, what are the risks of this recovery? A possible re-uptick in infection cases would certainly be, a bearish sign for markets and an impetus for things to tick back downwards. Now, so far, the research we've seen has been fairly encouraging on reinfection rates, and there's still lots of work to be done on antibody testing and really what that means for reinfection. But so far, we're encouraged again by what we're seeing there. So again, to summarize on momentum and sentiment, stocks are discounting a fairly strong recovery into the second half of the year and going forward in the overall economy. We've still got some work to do there, though, so that dial is in a neutral position for now. So not quite positive, not quite negative. So moving on to dial number 2, this is the economic fundamentals dial. Really what this is our way of saying that what happens in the real economy is ultimately what drives stock market performance. Now I've got a little math formula on the screen up there. We won't harp on that. There's no quiz here. But basically what this formula goes to show is that the price of the stock market ultimately depends on growth in global GDP. If we're looking at global stocks, if we're looking at US stocks, then that's going to ultimately depend on US GDP. We cannot have sustained stock market growth without growth in the underlying economy. The basic reason for that is that equities are essentially ownership shares of publicly traded businesses that determine growth in the private sector of the economy. Now, GDP does have government spending in there, so there's some things that the stock market cannot capture. But ultimately, stock price growth is going to depend on real economic growth. So what matters in the underlying economy does matter and is arguably the sole determinant for long-term stock market growth. So what's going on in the real economy? Obviously, we are in, again, this sort of unprecedented time of global shutdown of huge swaths and sometimes entire sectors of the economy. And again, that's really what drove the large stock sell-off in March in the United States, and before that in places like China and Asia, was the fact that we are going to see, and we already are now seeing, declining economic numbers. So, I referenced that GDP print this morning of negative 4.9% annualized growth for the first quarter. So that's a quarter that was really in the United States only, peripherally and partially affected by COVID lack of activity. Really, you had 2 months of kind of COVID-free, economic activity, so to speak. There were some ill effects from supply chains out of China, and exports did come down. But by and large, you had two months of unencumbered economic activity, and then March is when things really started to hit. So we're already seeing projections for Q2 GDP to be, could be anywhere from negative 25% to negative 40% of annualized growth, which again is just kind of an unprecedented fall off for economic activity. Now, obviously, that's because we've seen forced shutdowns of, again, huge parts of the economy. So why are we neutral on our economic fundamentals as opposed to completely negative? On the one hand, we would say that there are certainly some areas where, obviously e-commerce has not only held up well, but thrived in a time where people can't go to the store. There are other areas that should fare just fine. Obviously, healthcare is holding up well as well. And I'd say the other factor is, as we start to get production back online, we'll see these numbers start to pick back up again. So, areas like industrial production, where we have seen a bit of a fall off, it's going to take a little bit of time. So, some of these data points here, jobs created, real income has fallen off. We leave that green check mark there just because in our view, the unprecedented fiscal and monetary stimulus has really kind of replaced and even some areas for certain workers exceeded their previous income levels. So, there are some people who won't be so lucky. Certainly real income across the board will be affected, but including what we call transfer payments, so effectively just help from the government. We think income is going to be somewhat sustained. Building permits, things like residential and commercial construction, we have seen some pauses, but long-term trends are really pretty strong there. So that's encouraging on that front. Obviously, unemployment has been the big top line number that is just shocking, that we're seeing up to 25, 26 million folks unemployed as a result of COVID shutdowns. Now, again, the stimulus from the government and things like increased unemployment benefits are going to help on that regard, but it's just going to take time to get those people back to work. So that is certainly going to be a drag on the economy. So it's not as dour as things looked about a month ago, but we've got a ways to go before real economic activity picks back up. So that's why we're kind of sitting in a neutral reading there as well. This brings us to the third dial, which is valuation, which is essentially just, what price are we paying for our asset? Are we paying a fair price? Are we paying too much, or are we getting a good deal? Are we getting a bargain purchase? What the chart on the left really shows is that there is a significant correlation between the price that you pay for your asset, and whether that's a fair price or a cheap price or an overvaluation. And that has a direct effect on your long-term returns. So, essentially, if you're paying too much for anything, for food, for clothes, you're not getting as good of a return as you potentially could be, as if you've got that same, food or clothes or what have you on sale. You're getting essentially increased return and benefit to yourself. So we pay a lot of attention to what price we're paying for equities and any other investment asset. And right now, we would view valuation as still negative. So we think that, and I've kind of referenced this earlier, but we think that overvaluation in the equity markets did have an effect of kind of accelerating the decline in equities. We think we kind of saw what we call a priced for perfection stock market, which basically, equity participants were assuming that everything was just going to keep trucking along. The further we got from 2008, 2009, the more and more psychology just tends toward markets go up for forever. There's no bad days, there's no bad periods, and obviously we saw how that pretty quickly got turned on its head. With COVID and with the unprecedented shutdown. So we still haven't quite seen, we've seen valuations come down. We haven't seen them get to a place that we would call attractively priced. So we're still in a negative position on that. Even though we've seen equity prices come down, we've also seen earnings expectations be cut, either proportionately or in some cases even more so. We've got earnings declines projected of, up to 50% or more for certain sectors. So we haven't seen prices quite come down to a place where we would say stocks are now attractively priced. So we've still got a negative reading on that valuation dial for the time being. So in summary, with those three dials together, we've got two in a neutral position: momentum and sentiment as neutral, economic fundamentals as neutral, valuation we've still got as negative. So on balance, we are still, taking a somewhat defensive posture towards this overall market environment. Now, obviously, we're seeing some signs of strength and encouragement, so that gives us kind of a bit of an opportunistic tilt. So, I think if all three of these dials were to go negative, we would advocate for taking continued risk off the table. But for the time being, this is certainly a kind of a, for us, as long as we've got enough defensive and risk off assets in a client's portfolio, we're probably advocating for kind of a wait and see approach. This is going to be a long-term view, and we'll talk a little bit later about how taking a long-term view is really important when it comes to investing. But again, on the whole, kind of a defensive view, two dials neutral, one negative, but the potential for all three of those dials to potentially turn up in the future. So just to end here, we're gonna talk about some news topics and kind of how we think about the world and any piece of financial news or financial data that comes through, and kind of an example of how we try to filter that data through our three dials framework. So we've already talked a lot about the coronavirus. So again, how are the three dials guiding our conversations and our interpretation around COVID? We've talked about momentum and sentiment. I would say we would make the argument that really this is a purely momentum and sentiment driven market right now in the short term. Again, with GDP coming in 1% below consensus expectations, even I would market environment that would be a disaster for GDP expectations to be so off in the consensus. But because data is so hard to come by right now, because things are so volatile, I'd say the market is looking past that, and we're looking past the continuation of new cases. Now, we do think we're probably we've effectively flattened the curve, and I think the market is looking at that and looking at optimism towards the future of starting to reopen the economy. But again, the other dial that is going to be heavily affected by COVID is the fundamental dial. So how does the real economy, now that we're starting to see some reopenings, how quickly does the real economy start to recover, and how do some of those economic variables that we looked at earlier, how do those tick up, down, or stay the same based on economic reopenings? Other things that are kind of dominating the conversation, the oil shock. We had last week, oil futures briefly went negative in an unprecedented and first-time move for a commodity to trade negative on the futures market. Now, we could have a whole presentation on futures in the oil market. We won't spend too much time here, but we have the view that there was a lot of paper derivative trading that kind of contributed to that extreme level of sell-off. But obviously, we've got very low demand on, people aren't driving, machines aren't operating at full capacity, so demand has come way down on oil, and we've got this double whammy, so to speak, of OPEC and Saudi Arabia in specific trying to just flood the market with supply to gain market share and put some of these higher cost producers out of business, at least temporarily, to force shutdowns. So we've got an oversupply and under demand, and the third leg of that stool, so to speak, is nowhere to put any excess oil. So storage is really approaching capacity, and that's part of what led to that extreme sell-off and the negative activity in the futures market, is nobody wanted to take delivery of oil because nobody had anywhere to put it, and storage costs were skyrocketing. So how does that go through the three dials? Again, momentum and sentiment. We're going to weigh the benefit to the end consumer of lower oil prices. Obviously, once we get to start driving around a little bit more, we're going to be happy that we can fill up our gas tank at lower prices. Now, that should coincide with probably an uptick in gas prices. But again, what we're looking at is a benefit to the end consumer, weighed against the real cost of potential further job losses in energy markets and potential defaults from public energy companies. That'll show up again in the momentum and sentiment dial, and just how the market interprets that, and again how those effects trickle into the real economy will be seen in the fundamental dial. Moving forward, we've got some questions. I think these questions are starting to abate now, but is this the next financial crisis? The short answer for us is no. We think that the good news of 2008, 2009 is that the Fed learned an important lesson on making sure that we've got ample liquidity in the financial markets. So we did come into this with a lot of excess liquidity. We had excess reserves being held on bank balance sheets, so banks were very well capitalized heading into this to facilitate lending. Obviously, the monetary stimulus that's come into play on top of that has helped. So we've seen what we call financial conditions, or just basically the availability of credit and lending. It's tightened up a little bit, obviously, but we think we're nowhere near anything like we saw in 2008. So we think that the economy, again, as workers get back to work, as companies get back online, credit will be ample, and that will be an important part of our economic fundamentals dial. And interest rates will play an effect on the valuation dial as well. So if we do see higher interest rates, that could affect valuation. But we haven't, we've got record low zero interest rates again from the Fed, kind of similar to what we saw in 2009. But we will be watching that secondary effect on the valuation dial. Kind of carrying over, talking about stimulus into the national debt conversation. I think in the long term, we will see, we've got to pay for this one way or another. So does inflation tick up eventually? We think probably. We can talk more in depth about that later if anybody has any specific questions. But that for us, the good news at least is that interest cost as a percentage of GDP, which is basically how much of we could look at the same number of interest costs compared to income tax receipts from the government. So how much of our budget is being spent on interest? Was it a relative low? That is going to tick up. We're probably going to most projections show us getting back up to that 3% or so of GDP on the interest cost. So while the debt to GDP number is getting high, that interest to GDP number is still relatively low, though again expected to increase. So that'll have an effect on the economy. Obviously, an overburdened government debt is a drag on private sector economic activity. And the other piece of good news we would say is that again, probably as a consequence of 2008, 2009, individual balance sheets were really in a pretty strong position. Consumers had reduced their debt load. Over leveraged consumers, and especially in the mortgage and housing markets, were a big impetus for 08, 09's big collapse. So the good news is that we had fairly strong consumer balance sheets, and the consumer by and large was better prepared for this financial crisis or this economic crisis than they would have been in years past. So while that again should tick up, we'll start to see debt burdens become a little bit more burdensome, so to speak, as folks are out of work, and again, economic activity just isn't as strong as it was in the past. We think we're coming into this in a pretty healthy position. Geopolitical turmoil, if it's not COVID, it's going to be something else. There's COVID is by and large kind of what we call a black swan event, which is just something that can't really be predicted with any sort of modeling, or anybody who guessed that we'd have a big sell-off in the first part of the year, before we started seeing what COVID really was, just got lucky and was guessing. So geopolitical turmoil, the world is unfortunately just an unstable place. Life is imperfect. And risk exists in all parts of the financial market. So we think there's no way to eliminate all risk for most investors. Obviously, if you want to just keep your money in the money market and keep it at the bank, then there's obviously a significant return trade-off there. So we can't predict and we can't eliminate all risks. But as new situations develop, those do get filtered through all three of our dials. Lastly, political discourse. We always like to say that the three dials are apolitical. Now, we acknowledge that public policy is very important and will drive the economy ultimately, but the discourse around politics is can be particularly toxic sometimes, and again, it's just much more noise than it is news. We focus on the policies and their real economic effects. We just ignore the discourse, and that noise just doesn't enter into our three dials philosophy at all. So with that, I'm going to maybe stop for questions. Josh, if anybody's been chatting in any questions.
Yeah, I've got a few that have been sent in here. And if you have a question, you haven't taken advantage of it, feel free to jump on the chat and just send me the question. We'll make sure that we get it answered. I've actually got 2 or 3 already. One of them that just came in was, what asset classes and sectors do we find attractive given our defensive posture? And I just want to first say, I'm thankful that it wasn't what stock. That's the question we get asked all the time. Give me one stock. So I'm glad that wasn't the question. But Ethan, if you want to address both of those questions, asset classes and sectors based on defensive.
Yeah, I think let's start at the bigger level, the higher level asset class question. So, broadly speaking, stocks, bonds, commodities, and within kind of different subsectors there. Within equities, we think in times of turmoil, quality tends to win out over more speculative names. So we have a large cap tilt within our equity exposure. We'd rather buy kind of the blue chip areas of the market. We think small cap is an area that's been disproportionately hit. Obviously, smaller companies have less access to quick borrowing. Just generally speaking, less financial flexibility. So we think large cap over small cap is generally going to perform well. We still like U.S. over international. That's kind of been a long theme for us. Is the U.S. for all its imperfections is still really the best place to invest right now, in our opinion. Now there are certainly certain pockets across the globe that have had a pretty strong COVID response and have been very effective at flattening the curve, and I think that will pay dividends for their economies in the long run. But we do still have an overweight towards U.S. Versus international. Within fixed income, we are certainly we've been shying away from duration or interest rate risk, which is just to say we have kind of shied away from long-term, especially government bonds. We think interest rates, have been low for a long time, coming out of 2008, 2009. Could they go lower? Sure. We could always go into negative interest rate territory. That's not something that we're foreseeing at this time, but we'd rather have less, locked in long-term low interest rates and more flexibility on the shorter end of the interest rate spectrum. We think corporate bonds are really attractive over government right now. In times of crisis, you do see, kind of an excess level of risk that gets priced into even investment grade corporates right now. So, there are certainly areas, we mentioned energy earlier, where we're not really dying to dive into, speculative high yield energy debt. But just across the board, corporate over government, we think certain sectors of high yield are going to be attractive. They're one of the areas that have benefited from this kind of Fed backstop is they're going to make sure that as much as possible companies that may be forced into bankruptcy just because of the forced COVID shutdowns may not have to do that due to the Fed backstop, due to excess liquidity that's being provided. So I think there's some areas of value in there. Gold for us is a good hedge to the higher interest rate and potential inflation outcome that we could see down the road. So within commodities, oil is obviously got some struggles with the aforementioned supply-demand imbalance that we're seeing. We think gold could be a good hedge to have some commodity exposure there. I think that answers that question.
Yes, good job. Thanks for clarifying that. A question that came in earlier on new money. If new cash is being put in the market, how do we handle that? And then a question that just came in that's somewhat similar to that. I'll throw them both at you at the same time. With the VIX below 50 and dropping, and stock prices in the last 2 or 3 weeks were climbing, how do you determine when and at what pacing to deploy capital into a bear market? So I'll let you take both of those.
Yeah, I think that, generally speaking, I'm going to say we, both as a firm and as a human race, are not designed for market timing. So, to say that it's ever a good idea to be 100% in cash and then pick the day where you've got your entry point and go to 100% equities. You may get lucky every once in a while, but generally speaking, that's a losing game. So what we try to do just as a firm is use what we call we didn't invent this, but it's called dollar cost averaging. It's basically just picking your timeline and picking your amount and investing a set number of dollars into the market on kind of a predetermined schedule. Obviously giving yourself a little bit of leeway if you see a particular buying opportunity. But what that does for you is if you just say, for instance, we do a lot of just 6 month, once a month dollar cost averaging. And what that gives you is this 6 month runway where, we take, again, some of that emotion out of it, take some of the guesswork out of it and just say, we're going to invest 1/6 of this new cash every month, mid-month or beginning of the month, what have you. For 6 months. What that does is by investing a fixed dollar amount, it allows us to buy more shares when prices are down and fewer shares when prices are up. Mathematically, that gives us a lower average cost than we saw average price over that period if there's any sort of variation in pricing. So it just tends to be a good way to, take, again, the emotion and the guesswork out of it. It makes you put, so for instance, if you said, gosh, stocks have already rallied, 20% from the lows. Why wouldn't I just wait for them to sell off? You may not get that opportunity. So it forces you to start, getting your investment program underway. At the same time, there's always the possibility that we do see that, double bottom or a double dip or even a continued sustained sell-off. If we do, see a re-uptick in cases or we do just get that next black swan event that we don't even foresee on the horizon yet. It reduces your risk of putting all your money to work and then seeing, stocks or whatever your investment product is, head right back towards the lows. So, we think taking some sort of systematic approach, we always give ourselves a little bit of leeway. Again, if we do, see a particular few days of weakness, we may accelerate our schedule slightly, but that tends to be just the best. Being systematic about it is our best approach in our opinion.
Okay, I'll ask you to put on your sort of Nostradamus hat for a second with this one. With assuming things go well, we don't have an uptick in cases as markets and states are beginning to reopen economies. What kind of lag time do you foresee before we actually see this starting to impact the market and maybe even more importantly, market data?
Yeah, so, the consensus expectation, I'll speak to that, and I don't pretend to know more than the blue chip consensus out there, but, we've seen kind of the first leg of the economic hardship in Q1. We think Q2 should be significantly worse. Q3, maybe we stabilize or we start to recover. And then Q4 is when we start really kind of picking up some real acceleration in the underlying economy. Now, how that's reflected in the markets, that may already be priced in. I would say if that's the blue chip consensus, then that's what is being priced into stocks. One way I think about it is stocks are down roughly 9% thus far year to date on the S&P 500, and that that's give or take a few percent. But that may be about what GDP is down on the full year. We may see an 8% decline in real GDP. So that is what's being priced in roughly today. Now, the math is not that easy, and that's an oversimplification, certainly. But I think markets are always going to be seeking to price in what future changes are going to look like. So, again, if we had to pick a shape of the economic bounce, we think it's more of a U. If we had to pick a shape of the stock market bounce, maybe a W if we get any sort of retest of the lows. It's certainly looking very V-like right now, where we had that sharp decline and a sharp recovery. I would my best guess is it's not going to be that easy. There may still be a little bit of choppiness to come. I think we've maybe just gotten a little bit overly optimistic again, as far as the equity market, certainly. I think does that answer that question?
Yes. Can you speak a little bit to usage of ETFs?
Yeah. So, you mentioned individual stock picks earlier. Our philosophy is it's based on fairly on what's called the efficient market hypothesis, which is basically to say that most, if not all, of the information that is known, and even some that is unknown, is already priced into the market. So, what we have tended to see is picking individual stocks. Sometimes you win, sometimes you lose. A lot of times you end up coming out in the wash. The winners offset the losers. So what we've, as a firm, decided to do is really focus more on index investing through low-cost diversified ETFs, exchange-traded funds. So again, I've talked about the S&P 500 a few times as kind of just the barometer for large-cap U.S. stock performance. Our largest holding in most of our client accounts is an S&P 500 index ETF. It tracks the S&P 500 minus a small degree for fees. And our philosophy there is basically just let's get the market performance in our equities. Let's not take risks by owning individual names. We're going to be tactical around our overall asset allocation. So those are the areas that we kind of seek to add value. Going back to the 3 dials is just reducing our overall equity exposure when things are looking more bleak, adding equity exposure when things are looking more optimistic, and our kind of underlying asset class exposure, just seeking to reduce fees, achieve maximum diversification, and track the market with our underlying holdings.
Excellent. Well, thanks, Ethan. Want to honor everyone's time. If you have additional questions, Ethan and I will hang around for a few minutes. When we conclude here, feel free to jump on and ask those questions as well. Also want to bring your attention to the screen right now. If there's anything we can help you, help your family, our mission is really simple. We want to help families thrive across generations by matching their wealth with their purpose. And so whatever it might be involved in that for you, if there's any way we can help you, your family, your kids, to have a conversation and learn about good investing and good management of their wealth, we would love to do that. You see there on the left some things that we sort of specialize in, but I want to bring your attention specifically to things on the right. It's been a high-stress time for us as individuals in a country, and so if there's anything we can do to pray for you or to encourage you, we would love to help you in that regard as well in any way that we can. So having said that, if you have any other questions, feel free to let us know. Pay attention. There are other webinars coming up later this week and a whole new rollout next month of new webinars that we're presenting to help you be as informed as you can be on what's happening in the markets and also in your personal life and your personal portfolio. So with that, I'm going to wrap it up and hope you have a great week, great day. God bless.
Thanks, everybody.